Hello, my name is Taiwo Adeleke. I'm here to present on financial statement presentation. Number one here on my overview is balance sheet. Balance sheet is considered as financial statements that summarizes company's assets, liabilities, and shareholders' equity at a particular point in time. Balance sheet has three components that gives investors information about the current situation of the company, whether they are improving or not. The three components are assets, liabilities, shareholders' equity. Assets, these are company resources that was acquired through business transaction that has future economic value, which can be measured and declared in dollars. Liabilities are the money company owes the outside creditors such as rent, utilities, and salaries. Then shareholders' equity. This is the money given to the business owners and it is known as net asset. Income statement. This is known as financial statement that gives companies financial performance during a particular accounting period. The financial performance of a company is assessed by presenting the summary on how the company expend its revenues and expenses during operating and non-operating activities of the company. The uses of income statement. The income statement is used for data in order to calculate the financial ratios of the company, for instance, return on equity, return on asset, gross profit, operating profit, earning before interest and taxes, etc. of the company. Component of income statement. Instead, income statement has three components. Number one is revenue, number two is expenses, number three is gains and losses. Under the revenues, this actually considered as the amount accrued during sales of goods and services. Then the expenses, this basically include the cost of goods sold and expenses on interest. Then gains and losses, this is disposal of non-current assets that is different from their book value. Then we talk about the cash flow statement. The cash flow statement is considered as one of the quarterly financial reports publicly traded companies that are required to reveal to the US Securities and Exchange Commission and the public as well. It actually provided complete data that has to do with all the cash inflows which are received from the current operation and the external investment sources of the company. Also, all cash outflows that are paid for all the business activities and investment during a specific quarter will be provided as well to the Securities and Exchange Commission. Financial ratios. Financial ratios are considered as mathematical comparisons of financial statement accounts. The relationship between them help the investors, creditors, and company management. It also helps them to understand how a company is performing and which area need improvement in the company. Five categories of ratios. Number one, liquidity ratios. These ratios evaluate the ability of a company whether it's able to pay all its current liabilities as at when due and also its long-term liabilities as at when they become current. Number two, profitability ratios. The ratio makes a comparison between income statement accounts and categories in order to show that company has ability to generate profit from its operation. Number three is market prospect ratios. These ratios are used to distinguish between other publicly traded company stock prices with other financial measures such as earning and dividend rates. Debt ratios. This is also known as solvency ratios, which measures company's total liability as a percentage of its total assets. It also shows the ability of a company to pay all its liability with its assets. Activity ratios. These ratios actually measures company's ability to convert many accounts that are within its balance sheet to cash or sales. It also measures the effectiveness of a company on how it uses its assets and to determine whether the company is generating revenues and cash from its resources. Thank you for listening. This is the end of my presentation.